Let's zero in on the U.S. markets. They are closed today. We have seen futures moving slightly higher after President Trump deferred 50% tariffs on the European Union. We're joined now by Brian Mulberry, client portfolio manager at Zacks Investment Management. Brian, thanks very much for coming on the show.
Thank you.
You think that June could be choppy amid this to and fro, U-turns, etc., on tariffs?
Yeah, the market does not like uncertainty. And while we get it in small little steps here in terms of delays and looking at maximum pressure relieved from where we were on April 2nd till now, we just have this wave of pressure that builds up and then we get a release in terms of a delay. So that level of uncertainty just simply means more and more volatility. And I couldn't agree more that July 9th now becomes a very important date because so much is going to build up to that, not just the reciprocal tariffs, but also you have China and that negotiation ongoing that's going to coincide pretty closely in time with that same mid-July timeframe. So there's a whole lot that has to be answered for U.S. markets to continue to go higher from where they were. Obviously off their lows, but we're getting back to that wall of worry, more and more uncertainty. We could definitely see more volatility.
And speaking of worry, the concern over the U.S. deficit. I mean, it's been there for decades, I know, but the growing debt that is hanging over the market and helping to push up bond yields, it seems.
Yeah, absolutely. That uncertainty is continuing on to simply, can the U.S. afford to pay that debt longer term? And we're seeing longer dated bonds start to go up in their yield, trying to put pressure on answering that particular question. We're having to offer more and more yield because it seems to be more and more risky. Obviously, we got a downgrade from Moody's recently on that very issue. So it comes down to, can we get our fiscal house in order to pay down that debt over time? And there's a lot of questions that have to be answered there as well. What we're hearing is two sides of the story. Not enough cutting from the House of Representatives proposal that was just passed. The Senate has a much different idea of how they're going to go about it. The administration is making a separate case saying, hey, in addition to cutting spending, we can also grow revenue through other means, tariffs being one of those. But also, if we lower taxes, we tend to generate more revenue and pay down the debt that way. So there's a lot of assumptions that are going on, but the range of outcomes from all of these negotiations, again, builds into that wall of worry and uncertainty, and it's causing a lot of I think, harsh feelings in terms of the market and the valuation right now. Where do we go from here is really the question we're trying to answer.
You've probably seen this expression they've come up with on Wall Street, the taco trade. Trump always chickens out, meaning that he backs down from his tariff threats. But of course, that could be part of his negotiating technique.
Well, I mean, and we do have one actual trade deal that we can, I think, model going forward. And there were some pretty reciprocal outcomes in the UK deal that was struck a couple of weeks ago. It seems like, I think, more of the deals that do get announced over time will probably have a lot of that same reciprocity. Again, you saw Rolls-Royce benefit directly and Boeing in that kind of reciprocal trade where they're going to provide the engines that go on commercial airliners for Boeing. So when you look at country by country, the opportunities that are out there to strike these deals, I think, are very real, but we have to get them done in the background of all of this other stuff that needs to happen at the same time. So it seems like he negotiates from this ridiculous, leverage point, maximum pressure, maximum pain, and then settle back somewhere in the middle. I mean, if that's chickening out, fine, but as long as the result is good, the market won't care.
Walmart warning of higher prices. When Walmart speaks, obviously it carries weight. They have insight into the U.S. economy, to put it mildly. What did you take away from that?
Yeah, I think that they're, again, looking at long-term pricing structures. In the short term, over the next couple of quarters in particular, they seem to be okay in terms of sourcing the inventory that they need to get stocked on shelves through basically what will be the holiday season at this point in time. It's what happens after that. Will there be some type of a disruption that causes them to have to increase retail prices because wholesale prices have gone up so much in that same period of time? So it's really more a longer-term term hedge to say, hey, if we don't get all of these trade deals done, if we don't see a resolution, especially in terms of taxes going forward, which is another big item in the background, then obviously they're going to have to increase prices on the weight of all of that disruption in terms of their profitability. Remember, if they do nothing on the tax side, corporate rates go back to 28% from where they are now at 21%. Tariffs are one of those things where you can change behavior and try and avoid some of that cost structure, but taxes impact everybody all the time. And that will be, I think, even a bigger headwind that's not even get discussed enough, I think, at this moment in time. Also in that same timeline where we got to get it done by, July, August, September.
Thank you very much indeed for joining us. Brian Mulberry kicking off the week for us there, client portfolio manager at Zacks Investment Management. Coming